So imagine committing over $100 billion to build the largest network of liquid-cooled supercomputers in human history.
Right. Just a casual 100 billion.
Yeah, exactly. And you're doing this operating under the assumption that the world is permanently going to run on your silicon.
Mm-hmm.
But then you wake up this morning to realize the regional electrical grid physically cannot handle your power demands.
Oh.
And a foreign competitor just released a software workaround that basically makes your proprietary hardware obsolete.
Yeah, that's a bad morning.
Right. And to top it all off, the cost of the raw fuel required to keep the whole global supply chain moving just spiked 40% overnight.
It's the perfect storm.
It really is. And if you're managing institutional money this week, that isn't some hypothetical stress test scenario, right? That is simply the reality of today, Tuesday, July 28, 2026.
Yeah, it's a very intense week.
Welcome to today's deep dive, everyone. We are tearing into this massive macroeconomic event that the research team at Alpha Horizon Finance is officially calling the triple collision.
It's a very fitting name, honestly.
Yeah, and we're cross-referencing their latest briefing with, a stack of institutional desk notes and shipping data to figure out if the great American growth regime of the 2020s is merely catching its breath or if its foundational pillars have actually just snapped.
Which is exactly what we need to figure out. And, the term triple collision really captures the sheer velocity of what we're watching in the global equities and fixed income markets right now.
Oh, for sure. So for the folks listening, have you noticed your 401k looking a little shaky lately?
Right. Or feeling that sting at the gas pump.
Exactly. Or even just more expensive groceries. It's all connected. So what are these three forces that are colliding right now?
Well, for the last 3 years, capital allocators have comfortably relied on three structural assumptions.
Right. Okay. What were they?
First, that energy and logistics costs would remain suppressed.
Right.
Second, that capital expenditure in artificial intelligence would just generate infinite and immediate return on investment.
The endless AI money tree, basically.
Exactly. And third, that the Federal Reserve would maintain a relatively accommodating, predictable glide path.
But those are all falling apart now.
That's what makes this exact week so historically significant. All three of those assumptions are failing simultaneously.
Wow.
We're seeing a violent repricing of semiconductor infrastructure. Brent crude just reclaimed the $100 threshold.
Which is huge.
Yeah, on the back of severe maritime choke points. And there's a Federal Open Market Committee meeting starting today and tomorrow that is entirely rewriting the monetary playbook.
Okay, so it's the interconnectedness of those three failures that we really need to trace for you today. Because, the market doesn't exist in silos.
No, everything bleeds into everything else.
Right. So let's start with the absolute darling of the post-2023 rally, which is the hyperscalers and the semiconductor supply chain.
The foundation of the whole AI boom.
Exactly. We've seen the AI narrative drive just unprecedented multiples, but the Alpha Horizon briefing points to a sudden, aggressive repricing.
Yeah, it's been brutal to watch.
Brutal is the word. We are talking about heavyweights like Intel, Micron, and AMD shedding tens of billions in market capitalization in single trading sessions earlier this month.
Just massive wealth destruction in a single day.
And the selling pressure has gone fully global, right? It's dragging SK Hynix and Samsung down and functionally breaking the momentum of the Asian memory chip markets.
Yeah, it's not isolated to the U.S. at all.
So I want to look at the catalysts here, because this isn't just algorithmic profit-taking,
Right, there are fundamental drivers here.
Yeah, like we have Meta stepping forward and officially acknowledging the possibility of excess compute capacity. And that phrase alone, excess compute, it just seems to have broken the spell entirely.
Well, it breaks the spell because it violates the core operating thesis of the hyperscaler arms race,
How so?
Up until this month, the assumption baked into the valuations of companies like Meta, Alphabet, and Microsoft was that compute power was a zero-sum bottleneck.
Like you just can never have enough.
Exactly. The logic was whoever accrues the most GPUs, secures the most power purchase agreements, and builds the largest data centers, well, they win the foundational model war.
It was a total build it and the inference revenues will follow mentality.
Right. But Meta's admission of potential excess capacity introduces this terrifying concept to the semiconductor market, which is stranded capital.
Oh, stranded capital. That's a scary term for investors.
Yeah, it really is. I mean, think about it. If a hyperscaler builds a $5 billion data center cluster, right? And the utilization rates for the end-user AI applications don't ramp up to match the depreciation schedule of that hardware.
Oh.
Yeah, that facility becomes an incredibly expensive liability rather than an asset.
To put that into physical terms for you listening, it's like they haven't just been building a data center. They've been constructing a 10-lane fiber optic and silicon superhighway.
That's a great way to look at it.
Right. Like they bought the land, they secured the high voltage transformers, which, by the way, currently have a 3-year lead time on back order.
Yeah, the supply chain is still so tight there.
Exactly. So they laid the asphalt, absolutely convinced 1 billion autonomous vehicles were going to pay tolls to drive on it tomorrow.
But now,
You've got the foreman, like Meta, pulling over to look at the traffic projections and asking, wait, are there actually enough software applications to fill these lanes?
right, and that hesitation is a chilling moment for the companies selling the asphalt.
Yeah, the chip makers.
Exactly. And that hesitation is being aggressively compounded by the second trigger the briefing highlights, which brings us to the competitive landscape out of Asia.
Oh, right. China's Moonshot AI.
Yes, we are looking at the mid-July release of Moonshot AI's Kimi K3 model.
Which really shook things up.
It did. It's triggering massive flashbacks to the DeepSeek shock we witnessed back in early 2025.
Right, because everyone thought the U.S. export controls had basically capped what China could do.
Exactly. You have to understand how heavily the market had discounted Chinese AI capabilities due to those export controls on advanced lithography and top-tier silicon.
The consensus was basically that without access to the absolute bleeding-edge hardware, Chinese labs would hit an insurmountable compute wall.
But Kimi K3, much like DeepSeek before it, proves that assumption dangerously wrong.
How are they bypassing it?
Well, they're attacking the problem through algorithmic efficiency rather than brute force hardware scaling.
Yeah, I actually spent some time digging into the architecture notes on Kimi K3, and the mechanics of how they are achieving this are just fascinating.
Oh, really? What did you find?
Well, instead of relying on a massive, monolithic neural network that requires tens of thousands of top-tier GPUs running all concurrently, they have hyper-optimized a sparse mixture of experts architecture.
Okay, break that down for us.
So when you submit a prompt to Kimi K3, it isn't lighting up the entire trillion-parameter model, right? It's dynamically routing that query to highly specialized, much smaller subnetworks.
Ah, so it's only using what it needs in that exact moment.
Exactly. Which means they are achieving benchmark parity with top-tier U.S. models while using a fraction of the active inference compute.
That is wild.
And more importantly, they trained it on heavily distributed, older generation hardware that completely circumvented the most stringent export controls.
So if you are an American hyperscaler and you're modeling a 10-year payback period on your bleeding-edge hardware,
Yeah.
and a foreign competitor is achieving the exact same output for 20 cents on the dollar,
It absolutely destroys your margin projections.
it forces a total recalculation of the moat.
Right.
I mean, if the competitive advantage in artificial intelligence is shifting from hardware aggregation like who has the most silicon to algorithmic efficiency.
Who can do the most with less?
Exactly. If that's the shift, then the forward price to earnings multiples of the hardware providers just have to compress.
Right. They can't justify those crazy high valuations anymore.
But this brings up a really critical distinction that the Alpha Horizon analysts make.
Okay, what is it?
Institutional investors are largely classifying this as a valuation reset rather than a true demand collapse.
Oh, okay. So it's not like the sky is falling.
Right. We aren't seeing massive order cancellations at the foundries. TSMC's utilization rates remain incredibly tight, and the bookings for advanced packaging and high bandwidth memory, which is, why SK Hynix is so pivotal, they are still sold out through 2027.
So the fundamental demand for compute hasn't evaporated at all.
No doubt at all.
What evaporated was the willingness of the equity markets to price these stocks for absolute perfection.
Exactly. The moment the market shifts from momentum chasing to demanding actual return on investment metrics, the multiples compress.
The underlying tech is advancing, but the financial honeymoon of infinite capital expenditure is effectively over.
Yeah, reality is setting in.
And what makes the timing of this tech reality check so dangerous is that it is colliding with hard physical constraints in the commodity space.
This is where it gets real for everyday people.
Right. Building and running these AI clusters requires a staggering amount of baseload power. And just as Wall Street is questioning the financial cost of this infrastructure, the physical cost of energy is surging.
It's the accelerant to the fire.
Yeah. We need to look at the energy markets, specifically the fact that Brent crude has forcefully broken past $100 a barrel for the first time since early 2025.
Yeah, the transition from the abstract valuation of software companies to the unforgiving reality of the physical commodity market, that's where this triple collision really does its damage.
Because you can't decouple them.
You cannot separate the AI boom from the energy market. I mean, a single high-density AI rack can draw up to 100 kilowatts of power.
That's insane.
Data centers are basically competing with manufacturing facilities and residential grids for electricity.
But the immediate catalyst to pushing Brent crude over $100 isn't just data center demand, right?
Yeah, not to.
It is a severe, acute shock to global logistics originating in the Middle East.
Right.
And look, just to be completely clear for you listening, we are looking at this conflict exclusively through the lens of supply chain mechanics and maritime logistics. We are setting aside the political and diplomatic complexities of the ongoing U.S.-Iran conflict. We're not taking any political sides here. We're just impartially reporting on the economic impacts detailed in the source material.
Absolutely. From a purely economic standpoint, the shipping data out of the Gulf paints a very clear picture.
What are we seeing?
The intermittent military escalations have fundamentally altered the risk profile of the Strait of Hormuz.
And that's a massive deal.
It is. We are talking about a geographical choke point where roughly 20% of the world's daily global oil supply transits.
20%.
Right. And when you have heightened military activity in a waterway that narrow, it doesn't even require a physical blockade to disrupt the market.
The financial mechanisms of the shipping industry just do the work for you.
Exactly. You're pointing to the maritime insurance syndicates, specifically the Joint War Committee in London.
Right. When they get nervous, things get expensive.
Very expensive. When they classify a transit zone as high risk, the war risk premiums for very large crude carriers, or VLCCs, just skyrocket.
Like, how much are we talking?
We are seeing premiums jump from fractions of a percent of the hull's value to figures that make a single voyage economically prohibitive for many charterers.
Wow. So they can't even afford to sail it through there.
Exactly. So the alternative is rerouting these massive tankers all the way around the Cape of Good Hope.
Which takes forever.
It adds weeks to the transit time. It absorbs carrying capacity, reduces the overall availability of ships on the spot market, and sends daily charter rates through the roof.
So that $100 barrel of Brent crude isn't just reflecting a shortage of oil coming out of the ground?
No, not at all.
It is heavily pricing in the logistical nightmare of getting that oil from the Persian Gulf to the refineries in Europe and Asia.
That's right. And the transmission mechanism of that $100 crude into the broader economy is immediate and brutal.
Yeah, because crude oil is the base layer of the physical economy.
It gets refined into diesel, and diesel is what powers the global freight network.
Exactly. And if you look at the trucking spot rates detailed in the recent logistics reports, the diesel crack spread, which is basically the profit margin refiners make transforming crude into diesel, is holding firm.
Meaning the cost of moving physical goods across the North American continent is surging.
Surging. The Fortune report in our stack highlights how this is showing up right now, in late July, in something as mundane as back-to-school shopping.
Oh, really? Back to school?
Yeah. Like the cost of plastic binders, which are derived from petrochemicals.
Right, because of the oil.
And the cost of shipping those supplies to local retail distribution centers have both spiked.
That makes total sense.
Retailers are explicitly signaling on their earnings calls that they have exhausted their ability to absorb these logistics costs. The margin buffer is gone.
So they have to pass it on.
Exactly. They are passing this energy shock directly through to the consumer price index.
Which creates a formidable macroeconomic feedback loop.
Tell me about it.
You have a consumer base that is already experiencing fatigue, right? Suddenly, they're hit with a shadow tax in the form of higher energy and freight costs.
And when you pay more at the pump, you spend less at the mall.
Precisely. This reduces their discretionary income, which in turn pressures corporate earnings outside of the energy sector.
But the most systemic threat posed by $100 crude oil is how it alters the inflation data, right?
Absolutely. Energy is notoriously volatile, which is why central banks prefer to look at core inflation, stripping out food and energy.
But sustained $100 oil doesn't stay confined to the headline number.
No, it inevitably bleeds into the core metrics.
Like aviation, manufacturing, agriculture.
Exactly. It drives up the cost of agricultural production via petrochemical fertilizers, things like that. Prolonged energy shocks have a habit of deeply anchoring inflation expectations.
And the threat of those anchored inflation expectations brings the Federal Reserve directly into the crosshairs of this crisis.
The convergence point.
Right. We are sitting here on Tuesday, July 28. The Federal Open Market Committee has convened in Washington. This is the third pillar of our collision.
And we are no longer dealing with the Fed of 2024 or 2025.
No, we are not. We have Chair Kevin Warsh, who assumed the role in May of this year, and the entire philosophical tone of the central bank has shifted significantly toward hawkishness.
The contrast in monetary philosophy is stark.
Again, just a reminder for you all listening, we're not taking any political stance on Fed policy, just reporting on the economic reality they're facing based on the briefing.
Right. Because earlier in 2026, the bond market had heavily priced in a Goldilocks scenario, right?
It's a soft landing.
Exactly, where inflation naturally drifted down to the 2% target, allowing the Fed to comfortably execute a series of rate cuts.
But that dream died in June.
It was shattered at the June FOMC meeting. The summary of economic projections, specifically the dot plot showing where committee members expect rates to be, it shifted aggressively upward.
You had nearly half the committee signaling support for further tightening later in the year, effectively killing the narrative of imminent easing.
Yeah. Chair Warsh has consistently emphasized that premature victory declarations over inflation are the greatest historical mistake a central bank can make.
Echoing the lessons of the 1970s.
Exactly.
But wait, looking at the Fed funds futures and the analysis from CBS News and Forbes that we have here, the derivatives market is only pricing in roughly a 25% probability of an actual rate hike at the conclusion of this specific meeting today and tomorrow.
Right.
So if the mechanical probability of them raising the benchmark rate today or tomorrow is that low, why is the institutional space treating this specific press conference as a make-or-break moment for the remainder of the year?
It's a great question.
Yeah.
And it's because the institutional space understands that the Federal Reserve's primary policy tool isn't necessarily the overnight rate itself.
Okay, what is it?
It is forward guidance. It is the management of financial conditions through communication. It's the tone.
The tone.
The Goldman Sachs strategy note in our briefing perfectly isolates this dynamic. The Fed is staring down a resurgent oil-driven inflation wave, just as the labor market is beginning to show complex mixed signals.
Right.
So if Chair Warsh uses the press conference tomorrow to validate the threat of the energy shock,
Like, if his language signals that the Fed views $100 oil not as a transient geopolitical anomaly, but as a structural driver of core inflation that they have to actively fight?
yes, then the entire yield curve is going to violently reprice.
Wow. So the bond market will immediately interpret that tone as a guarantee of higher for longer.
Exactly. The term premium on the 10-year Treasury will expand. The assumption that the Fed will step in with rate cuts to rescue a slowing economy, the infamous Fed put that equities have relied on for over a decade,
Will be officially dead.
officially dead. Warsh would essentially be telling the market that their mandate to crush inflation supersedes any desire to prop up equity valuations or ease corporate borrowing costs.
That is a massive shift, and a persistent higher for longer regime fundamentally alters the math of capital allocation.
It changes everything.
Right, because if the risk-free rate on a Treasury bill remains highly elevated, the hurdle rate for investing in risky equities, especially growth-oriented tech stocks that derive most of their valuation from cash flows promised far in the future, becomes much harder to clear.
It puts immense pressure on corporate treasurers.
Yeah.
They have massive debt walls approaching in 2027 and will have to refinance their corporate bonds at significantly higher interest rates.
This is why the intersection of the AI infrastructure repricing and the Fed's hawkishness is so toxic for the NASDAQ.
Right.
You have companies that need to borrow billions to build data centers facing a central bank that is deliberately keeping the cost of that borrowing punitive because an energy shock on the other side of the planet is driving up inflation.
It's all connected. And that perfectly synthesizes the mechanics of the bear case that is heavily featured in the Alpha Horizon briefing.
Okay, let's get into the risk scenarios, the bear case.
The nightmare scenario here is a textbook stagflationary spiral, just updated for the AI era.
So the geopolitical conflict keeps crude above $100. That sustained energy shock forces the Fed to hold rates at restrictive levels or even execute that hike later in the year.
Exactly. And facing those punitive capital costs and squeezed margins, the hyperscalers drastically cut their capital expenditure.
The 10-lane superhighway gets abandoned mid-construction.
Right. Chipmakers revised their forward guidance downward, triggering a massive wealth destruction event in the tech sector, which, let's remember, has been the primary engine of the S&P 500's gains.
So you end up with stalled technological growth, high consumer prices, and punishing borrowing costs all operating simultaneously.
It is a formidable combination of headwinds.
That sounds terrifying for any investor.
It does. However, financial markets are adaptive systems, and the briefing is careful to present the counter-narrative too,
The bull case.
or perhaps more accurately, the opportunity case.
Okay, I like opportunity. What does that look like?
The argument here is that viewing this triple collision purely as a macroeconomic disaster ignores the structural necessity of market rotations.
So it's like a reset.
Exactly. The extreme concentration of capital in a handful of mega-cap AI stocks had created a fragility in the broader market.
I see the logic there. If you look at the divergence between the market cap weighted S&P 500 and the equal weight index over the last 2 years, the concentration has been historic.
Unprecedented.
Right. Capital hasn't been flowing into the broader economy. It's been vacuumed up by 5 or 6 tech giants.
So if the AI momentum trade breaks, that capital doesn't just vanish into the ether, you know?
Right. Institutional mandates require allocation. They have to put that money somewhere.
Exactly. If tech multiples are compressing, money seeks yield and value elsewhere.
So we could see a massive rotation into sectors that have been starved of capital.
Precisely. Traditional energy infrastructure, industrials, defense contractors, utility.
The actual physical machinery of the economy.
That rotation is exactly what the value-oriented strategists are anticipating.
That makes a lot of sense.
If we are entering an era defined by geopolitical friction and supply chain onshoring, the companies that build physical things, secure energy grids, and manufacture defense systems become the new premium assets.
And furthermore, the bull case addresses the AI sector itself, doesn't it?
It does. An environment where capital is expensive and investors demand immediate ROI forces discipline.
It shakes out the speculative vaporware AI startups.
Exactly. It forces the major players to focus on models that actually generate revenue, rather than just pursuing parameter counts for the sake of press releases.
A disciplined technology sector trading on realistic cash flows is a much healthier foundation for long-term equity growth than a market running on infinite compute fever dreams.
It transitions the AI industry from the research and hype phase into the commercial execution phase.
That's a really crucial perspective. But, to ground all of this institutional strategy back into the daily reality of the broader economy.
Right, to the listeners.
Yeah, for you listening, we have to look at what this triple collision means outside the trading desks.
Because it affects everyone.
When Wall Street argues about terminal rates, yield curves, and the duration of the energy shock, they are ultimately debating the cost of everyday life.
They absolutely are.
The mechanics we've dissected today, from the Strait of Hormuz to Meta's server racks to the Fed's dot plot, are the literal mechanisms dictating why your 30-year fixed mortgage might stubbornly sit at 7% instead of dropping to 5%.
Exactly. It dictates the interest rate on a small business loan for a local logistics company.
It explains why credit card APRs are eating into household budgets right now.
The transmission from macro policy to household reality is undeniable. The Federal Reserve's battle against energy-driven inflation operates by intentionally slowing down demand.
And what does that look like?
That means tighter lending standards, which leads to slower local hiring, which cools wage growth.
Ouch.
Yeah. The listener navigating the housing market or managing a personal portfolio is feeling the physical weight of these three colliding forces.
So the assumption that the post-pandemic inflation was fully conquered and that we were returning to the low interest rate environment of the 2010s.
It has to be completely reevaluated in the face of this data.
Which means we have some highly critical milestones to watch in the immediate future to see which of these scenarios takes hold.
We do. Tomorrow afternoon is massive.
Right. Tomorrow afternoon, all eyes are on Chair Warsh. The market will be forensically parsing his language during the FOMC press conference.
We need to hear exactly how the committee is weighting the inflationary impact of $100 crude against the softening data in some of the regional manufacturing surveys.
Because if he leans heavily into the inflation threat and just dismisses the tech sector's volatility as irrelevant to their mandate,
the higher for longer reality will lock in across the bond market.
Just like that.
And following the Fed, the next major hurdle will be the upcoming earnings reports and forward guidance from the semiconductor foundries and the primary chip designers.
We need to see the actual order books.
Exactly. That will provide the ground truth on whether Meta's commentary was an isolated incident of capacity management or the leading edge of a massive sector-wide pullback in AI capital expenditure.
We need to see if the threat from highly efficient open source models like Kimi K3 is actually altering procurement behavior among the hyperscalers in real time.
It is a masterclass in how rapidly a macroeconomic regime can fracture.
It really is. I mean, we have spent the last 3 years assuming the dominance of US AI hardware, the relative stability of global energy logistics, and a central bank that was eager to ease policy.
And this week we are watching the market rigorously stress test the failure of all three.
It's intense.
It leads to a fundamental question regarding the architecture of the global economy, something for you to think about after we sign off today.
Oh, I like this. What is it?
Well, if the era of zero interest rate policy is permanently behind us, and if energy costs remain structurally elevated due to a fragmented geopolitical landscape,
Right.
and if the initial speculative wave of artificial intelligence has exhausted its momentum, the underlying formula for equity expansion has to change.
So, what does the next engine of genuine economic productivity actually look like when the era of cheap capital and cheap fuel is over? Wow. That is exactly the paradigm shift we need to be watching for. Because when the dust from this collision finally settles, the leaders of the next market cycle likely won't be the ones reliant on infinite leverage or uninterrupted global supply chains.
It's a profound shift in the mechanics of growth.
Absolutely. We will be tracking the fallout from the Fed's press conference closely and analyzing those semiconductor order books as soon as the ink is dry. Thank you for diving into the mechanics of this week's market shock with us.
Until next time, keep looking at the data behind the headlines.